Welcome to the Deep Dive, your essential shortcut to the critical takeaways from the latest corporate earnings calls and business updates.
Today, we are focusing on Longeveron, that's ticker LGVN, following their Q3 2025 financial results and business update call, which just dropped on November 4th.
And the story here is really the classic biotech catch-22, isn't it? You have this company with incredibly promising, high-value science in rare diseases, but that runway is being just constantly undercut by these immediate crushing financial constraints.
Exactly. The call was heavy on the scientific potential, and we'll get into that. But the entire conversation was just stressed by this looming liquidity deadline. For investors, I think this was less about clinical updates and more about just counting the months of cash they have left.
Okay, so they missed on everything.
Yeah.
Let's start right there. What did the Q3 numbers actually look like, and why did the market react so harshly?
Well, it was a substantial miss across the board. Longeveron reported a GAAP EPS loss of negative 39 cents.
Ouch. And consensus was what, around negative 26?
That's right. So it blew past that. And what's worse is that loss per share is actually widening year over year.
And I'm guessing the revenue story wasn't much better.
No, not at all. Revenue was only $0.14 million, which severely missed the consensus of around $0.29 million. That's an 82% decline.
Wow.
Yeah. So when you add it all up, the 9-month net loss accelerated by a huge 45% to $17.3 million.
So if you just look at the stock chart, I mean, the sentiment reflects all of that strain. The stock's down, what, about 66% over the past year?
It is. It's sitting right near the bottom of its 52-week range. It's, it's pretty clear that right now the price of LGVN is being driven entirely by the balance sheet, not the bench science.
Right, which leads us directly to that core problem, liquidity. Let's unpack where the cash is going and how management is trying to handle this burn rate.
The increasing loss is definitely driven by significant jumps in operating expenses. They're pushing hard toward commercial readiness, and that costs money.
Okay, so where specifically are they pouring that capital?
Well, G&A is up, but the biggest surge by far was in research and development, R&D, which jumped 52% to $9.3 million. A lot of that is tied to what they call BLA-enabling work.
Okay, let's break that down for our listeners. BLA is the application for approval, but what's the expensive part of getting ready for that?
It's the CMC, chemistry, manufacturing, and controls. I mean, you can't even submit your application to the FDA without having your manufacturing process completely locked down, proven, and scalable.
So this is them paying to prove they can actually make the drug reliably at scale.
Exactly. And that involves really expensive regulatory grade manufacturing runs. But that cash drain, of course, raises the big question. How long can they actually sustain this?
And that's the late Q1 2026 cliff everyone's talked about, right?
Precisely. As of September 30th, cash and equivalents were only $9.2 million. Even after an offering in August and using their ATM facility, management is only guiding that the cash runway lasts into late Q1 2026.
Late Q1 2026. That is a ridiculously tight window.
It is. And the CFO commentary on the call really drove that fear home. He explicitly stated that a failure to secure more capital would mean a material revision to their operating plan.
Which is corporate speak for, we have to delay or even halt a major program.
It is. And that operational risk, that fear of massive dilution, is why the market is just fixated on solvency over the science right now.
Okay, so let's pivot from the terrifying financials to the promising science. They're burning $9.3 million on R&D. What are they buying with that money? Let's talk about laromestrocel.
This is where it gets genuinely impressive. The lead program is LPIS-2. It's in hypoplastic left heart syndrome, or HLHS.
Which is a life-threatening rare heart defect in infants.
Exactly. That pivotal phase 2b trial is now fully enrolled with 40 infants, and we're still expecting top-line data in Q3 2026.
But they did announce a delay to the BLA submission. It's pushed from late 2026 into 2027. They claim it's a disciplined financial move, but doesn't that sort of signal a lack of confidence?
That's the key question, But based on the call, it really does seem strategic and financial. They're just slowing down the most expensive parts, like the full CMC push to stretch their cash. Their confidence, they say, comes directly from the phase 1 data.
Which were, to put it mildly, striking.
Absolutely striking. The prior LPIS I study showed 100% 5-year transplant-free survival in the children who got the treatment.
Wait, 100%?
100%. And you have to contrast that with historical controls, where you'd expect approximately 20% of those children to either die or need a heart transplant in that same period.
That's not just a good result. That's a paradigm-shifting number for a condition this devastating. And they've got the regulatory tailwinds too, right?
They do. They've got orphan drug, fast track, and rare pediatric disease designations. If the pivotal data looks anything like phase 1, that path to approval gets a lot shorter.
Okay, now let's move beyond pediatric cardiology to the colossal opportunity in Alzheimer's, the Clear Mind program.
Right, so that program had its phase 2A results published in Nature Medicine.
Which is a huge scientific validation.
Enormous validation. And they had a Type B meeting with the FDA where they got alignment that a single pivotal phase 23 study could actually be enough to support a BLA.
Fantastic news, but the cost of a phase 3 Alzheimer's trial is astronomical.
It is, and management knows they can't afford it. So their priority for Alzheimer's is now actively, and I mean actively, pursuing strategic partners to fund it. They're basically using that Nature Medicine paper as bait to draw in big pharma capital.
And they even expanded the pipeline to another pediatric indication.
They did. They got an IND approved to move directly into a pivotal trial for pediatric dilated cardiomyopathy, DCM. But, and this is the key phrase from the call, that trial is subject to financing.
Everything comes back to the cash cliff.
It all does. The whole strategy is to get that first approval in rare cardiology to stabilize the company while holding the Alzheimer's program as a bargaining chip for a partnership.
Which seems smart. And that pragmatism extends to how they're planning to manufacture and sell the drug too, right?
Absolutely. They're moving production to a third-party CMO, a contract manufacturing organization. That's necessary for scale, but it's also a huge part of those rising R&D costs we talked about.
And on the commercial side, they aren't planning to build some massive internal sales team.
No, that would be financial suicide. They're looking for partners outside the U.S., and critically, they're even exploring U.S. partnerships for these niche markets like HLHS.
Which makes a lot of sense. You only need to reach a handful of major pediatric transplant centers.
Right. Why build out your own team when you can leverage a partner's existing infrastructure? It maximizes revenue and minimizes cost.
So ultimately, the stock's performance really highlights the core tension for you, the listener. Is this a high-potential platform asset backed by incredible science? Or is it just another undercapitalized microcap facing a binary clinical outcome and a definite dilution event?
It's the ultimate market paradox. You have the promise of 100% survival data on one hand and a Q1 2026 bankruptcy clock on the other. The market is clearly discounting their ability to solve that solvency problem.
All right, for our final segment, let's use this disconnect to game out an outrageous but plausible hypothetical scenario.
And we have to say, this is strictly for analytical purposes. It is not financial advice.
This is not financial advice.
Yeah.
But given the stock is down 66%, the market is basically pricing in either failure or catastrophic dilution before that pivotal data comes out in Q3 2026.
So what's the trade idea that plays on that short-term fear?
The idea is a long-term binary bet. You purchase deep in the money call options that expire in Q4 2026 or even later.
So the rationale is you completely bypass the near-term financing jitters.
Exactly. You're not betting on whether they can raise money next quarter. You're betting solely on one thing, that the striking phase 1 results, that 100% survival rate, get replicated in the pivotal trial.
And if LPI second succeeds, the stock could easily surge back toward or well beyond its old highs. The leverage from the option could deliver exponential returns.
It's a pure bet on science over solvency.
The definition of binary risk. You either lose the premium you paid or you capture the upside of a de-risked rare disease asset.
So what does this all mean for you? Longeveron is in a race against time. They have until late Q1 2026 to prove they can raise the capital they need.
And the key takeaway from the call was that strategic delay. Management bought themselves some precious runway, but it cost them speed, pushing that potential approval out to 2027. So investors now need to watch for partnership news like a hawk. That's the only thing that matters before the data readout.
And the provocative thought to leave you with is this. Given the deep discount and the fact they just announced a new patent on aging-related frailty broadening the platform's potential, does the market fundamentally misunderstand the long-term value here? Or is that Q1 2026 cash cliff just too high to climb?
That is the ultimate test of science versus solvency. Thank you for joining us for the deep dive.